Well, hello world, I'm L.A. Little, and this is the Neoclassical Technical Analysis site, tatoday.com, where a community of like-minded traders gather around to share and review trading ideas, neoclassical principles. If you want to get some of the content, just come over here, log in. If you're not logged in, then register, right? You can register here on the site, just create an account, and that will get you going. You can review all of that by clicking on the monitor activity. If you want more information about how to join the site, here you get 2-week delayed content. Of course, you can become part of the site and get up-to-date content as we review it here at TA Today. You also have the ability to get at some of this information, especially the trading game. This is based on neoclassical principles. If you click on that, you'll have to register, and once registered, then you'll be able to get at that game, which is the TA Today neoclassical game. It basically takes historical data, allows you to play a game based on that data, and pops up all 3 time frames. All the principles of the neoclassical model are contained here. You can come over to the chart game help, click on it, come in. There's some videos, there's quite a few of them here that you can review that give you a demonstration of how this game works and how you can use it to learn the neoclassical principles. Of course, our focus today is not on a game, but on the reality of the wealth that's getting wiped out in the current market. So let's pop up the charts, take a look at those, and see what's happening. So I'll start here with the S&P 500, and we'll talk about the potential for some sort of a bounce trying to set up here on these markets. So if we look at the S&P 500 and we look at the structure that's starting to take place, one of the things that pops out at you is the fact that the volume has been expanding right on the way down, and that's what you saw back here. And off that expansion down after it had played out, right, you get a big bounce. And that's what makes it so hard to short markets, is that the bounces are violent and fast, right? And they usually come just as quickly as the downside came in terms of the violence of the bounce. And we've seen that twice already. There was one here, there was another one just here this last week where you saw 3-4% down, and then all of a sudden 2-3% back up. If you're shorting, you want to cover. That fuels the bounce, right? But if there's no real buyers coming in at that level, then the very next day or a day later, you get the same sort of thing back to the downside. And that's what we've been seeing here as this market cascades lower. The question is are we at a point now where we're going to get a bounce that's sustainable? Are we going to see some new money come in here? Are we going to see the strong hands come in? We don't have any evidence of that yet, at least not on this time frame, not on the daily time frame with the particular index. Now, if we move over and we look at the indexes on a weekly time frame, and we're still sticking with the S&P 500 here, again, we don't have anything here to tell us that we've got any kind of a bottom, right? All we have is failures. We have a failed bullish retest regenerate here. We had a failed one up there. We also saw the classical retest regenerate scenario, and that retest regenerate scenario is you come down, you break a swing point highs low, right? Then you bounce back up to test, and then you regenerate to the downside. And that's what we've seen so far. And that's a precursor to a market that's failing, right? And that is going lower. It's going sideways at best, potentially lower. And so, when you see that kind of structure take place, what it's telling you is that what was up is most likely sideways at best and potentially has turned to the downside. And you have to be aware of that. Then you have to modify your trading plans as a result. Let's move to the monthly time frame and look at that. Here you actually have the same sort of a thing taking place, and that is here on the monthly you have a bullish retest regenerate that is attempting to fail. Now we have 3 more trading days, so it may end up not failing by the end of the month, but right now that is in the cards, and potentially some sort of a damaging situation that's going on. What I want to show you though is that there is the potential for some changes to take place, and those changes are starting to show up here in the sectors. Now, last week, if you remember, we talked about the SOX, and having the SOX is one of those great trading opportunities. Actually, it was the one we highlighted last week. And essentially what we said was, as this thing comes down and fails, if it fails, you're going to get a faster move. Now, this was the week before. Last week, I highlighted this one and said if we fell there, you're going to get a faster move to the downside, and that's what we got, is about 6%. If you're playing with those leverage ETFs, you pushed a 18-20% move on that break. Why do I come to this though this week in terms of a potential setup for the turn? Well, it's because what you're seeing, not only here but elsewhere, is you're seeing price push down, get under, can't go any lower, volume starting to tail off. When you see that, that says that, hey, we've kind of like flushed out everybody, and we're going to try to bounce this thing back. And so where can it bounce to? And you have to look at each of these charts individually, but it can bounce back to the bearish retest, regenerate. And so, for example, a purchase at this price could lead you to a bounce that would take you way back up here. That's $10 on a 155 basis. You're talking about a fairly significant bounce, right? 6%, 6+%. Again, if you're looking at a leveraged ETF, that's about a 20% move, and it probably will come within 2 or 3 days when it happens. What's your downside? Well, you don't have to give up a lot, right? If this thing opens tomorrow and it opens at the same price point and it tries to test lower and again fails to be able to stay lower and the volume is light, that's a good opportunity to buy, put your stops up underneath it, and try to get that run back to the top side. How far you allow it, right, is a measure of a risk-reward. Your probabilities are not great here, right, because your counter trend bounce, is what you're doing. Counter trends are tough to trade, just like they're usually tough to trade on the downside. They're tough to trade on the upside when the trend is against you, and the trend is clearly against you on this time frame. And it's not only on this time frame, right? If we look at it on the weekly time frame, which we just did, it's a break to the downside there. And if you go over the monthly actually is changing to a sideways as well. So you actually have a counter trend trade. Those trades are quick, fast, and furious. You get in, you find your spot, you take your position, and you run it back the other way, and then you flip right back out of it. And matter of fact, in this particular case, not only would I flip out of it, I would probably look to short it again. And matter of fact, if you want to play the safer trade is to let it come back up here and trade the bounce to the short side. That requires a little patience. You just have to wait. But if you did ride that down last week with me, this was the place to take your money. And if you haven't, I'd look at taking it first thing on Monday. That's it for this week. Have yourself a great one. I'm glad to see you join me. If you like what you see, give it a like. Share it with your friends. The links are there. You can click and share it. And I'd appreciate your distribution of my material to others who probably haven't heard about me. Have a great one. Take care. See you next time.